Welcome to the Riskwiser Zone, the show where we dive into the world of finance and explore the latest trends, risks, and opportunities. I'm your host, Lewis, and today we're going to talk about debt settlement, a topic that's often shrouded in controversy and misconceptions. As we navigate the complex landscape of personal finance, it's essential to understand the pros and cons of debt settlement and how it can impact our credit scores and financial well-being. On one hand, debt settlement companies can help individuals pay down their debt balances by negotiating with creditors on their behalf. However, this process often comes with significant fees, which can range from 15% to 25% of the total debt amount. Moreover, debt settlement typically requires individuals to stop making payments on their debts for a period of time, which can lead to late fees, interest charges, and damage to their credit scores. In fact, settled debts can remain on credit reports for up to 7 years, making it challenging for individuals to obtain new credit or loans in the future. On the other hand, some argue that debt settlement can be a viable option for those struggling with overwhelming debt, particularly when compared to bankruptcy or debt consolidation. By negotiating with creditors, individuals may be able to reduce their debt burden and avoid the long-term consequences of defaulting on their debts. It's crucial to approach debt settlement with caution and carefully weigh the potential benefits against the risks. As we'll explore in more detail later in the show, there are alternative options available, such as credit counseling and debt management plans, which may offer more sustainable and less risky solutions for managing debt. As we continue to navigate the world of finance, it's essential to stay informed and make educated decisions about our financial lives. Whether you're struggling with debt or simply looking to improve your financial literacy, we're here to provide you with balanced and unbiased information to help you achieve your goals. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're continuing our discussion on the latest market trends and news. Today, we're looking at 3 key stories that caught our attention. First, let's talk about the shift in investor behavior in the Indian stock market. It appears that domestic investors are increasingly favoring individual stocks over index funds, leading to a surge in trading activity. According to reports, this trend is being driven by the growing popularity of online trading platforms and the ease of access to market information. While this shift may indicate a more active and engaged investor base, it also raises concerns about market volatility and the potential for increased risk-taking. Moving on to our next story, we have some insights from the U.S. bond market. Strategists are warning that margin pressure and slower growth outlooks may impact certain stocks, such as Sun Pharmaceutical Industries. The company's latest quarterly results showed double-digit growth in revenue and net profit, but operating margins were under pressure due to higher investments and lower milestone income. With revenue growth expected to moderate in the coming fiscal year, investors are advised to exercise caution and consider the potential risks and challenges facing the company. Lastly, let's take a look at the broader economic landscape. The ongoing conflict in the Middle East and its impact on global markets is a pressing concern. Analysts predict that U.S. bond yields may remain elevated due to the geopolitical uncertainty, which could have far-reaching implications for investors and the overall economy. As we navigate these complex and interconnected markets, it's essential to stay informed and adapt to changing circumstances. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the current state of the economy and how it may impact your financial decisions. We've been discussing the recent rise in Treasury yields and what this means for investors, borrowers, and savers alike. To break it down, when Treasury yields increase, it can lead to higher borrowing costs for both the government and households. This, in turn, can cause mortgage rates to rise, making it more expensive for people to purchase or refinance homes. On the other hand, higher Treasury yields can also lead to better returns on savings accounts and CDs, which is good news for those looking to grow their wealth. It's essential to understand how these changes can affect your individual financial situation. If you're a stock investor, you may want to consider rebalancing your portfolio to include more dividend-paying value stocks with strong cash flow and low debt. Bond investors should review their holdings and consider a bond ladder with varying treasury maturities to minimize potential losses. For those with 401k or IRA accounts, it's crucial to have a proper mix of stocks, bonds, and cash to weather interest rate changes and market volatility. And if you're a saver, look for opportunities to enhance your returns by moving cash into higher-yielding accounts, such as CDs and short-term treasuries. As a borrower, consider paying down variable-rate accounts, like credit cards and HELOCs, to avoid rising interest rates. Mortgage rates may move higher, but being financially prepared will help you make a move when you find a rate that fits your budget. In conclusion, it's vital to stay informed about the current economic landscape and how it may impact your financial decisions. By understanding the relationship between treasury yields, inflation, and interest rates, you can make more informed choices to protect and grow your wealth. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.